Hey everyone, welcome back. Let's quickly run through what's been going on in the markets this past week. And yeah, it's been a big one, but no, we're not going to be talking Iran and Israel conflict. We've got the US and China finally cooling off on tariffs, investors pulling out of US stocks and heading for Europe and emerging markets, and some surprising inflation numbers from the US. On June 11th, Trump said the US-China trade talks in London are basically done, and now it's just about signing the papers. Here's what's in the deal. US tariffs on Chinese goods will sit at 55%. That's 25% from Trump's first term, and another 30% slapped on in his second. China keeps its tariffs at 10%. Now, if you remember the peak of the trade war, US tariffs hit 145%. So this is technically progress, but 55% is still really high. China also agreed to open up exports of rare earth minerals, which are huge for tech, EVs, and defense. And in return, the US is loosening up on things like jet engines and letting Chinese students back into American universities. Yeah. Now here's the thing, this doesn't solve the big issues. It just pauses the fight. Prices are still going to stay high for a lot of goods. And small Chinese businesses are barely breaking even just to keep American buyers. But the rare earth access, that's a real win for US manufacturers. It could bring down costs for things like EVs and semiconductors. Investors are kind of happy, but they're not bidding the house just yet. The deal needs to actually work, not just sound good on paper. So let's stay cautiously optimistic about it. Same day, Reuters drops this. Investors are leaving US stocks in a big way. In May alone, $24.7 billion flowed out of US equity funds. At the same time, Europe got a record of 21 billion euros in, and emerging markets grabbed another 3.6 billion euros. So what's going on? The US dollar is weaker, national debt is ballooning, and people are losing patience with the US fiscal chaos and high tariffs. Meanwhile, Europe's looking pretty attractive. The ECB is cutting rates, governments are spending more on infrastructure and defense, and even Blackstone says they're planning to invest 500 billion euros there over the next decade. Emerging markets are also looking stable. Lower debt, cheaper stocks, better yields. It's basically, why stay in the US when better deals are out there? And if this keeps up, we could see a serious momentum shift. Stronger currencies, more investment, and growth in places outside the US, while the US might face more volatility and pressure to keep rates high. Okay, let's talk inflation. The US inflation report just came in, and it's cooler than expected. Month over month, plus 0.1%. Year over year, 2.4%. Core inflation, that is, without food and energy, 2.8%. Forecasters expected prices for stuff like clothes and cars to rise, but they actually dropped. Fuel and goods are cheaper, but housing is still the main thing driving prices up. Now, cooler inflation usually means the Fed can start thinking about cutting interest rates. Bond yields dropped, the 10-year Treasury fell below 4.4%, and mortgage rates are following. That's great news if you're house hunting. Lower rates equals more buyers jumping in equals housing prices could start creeping back up. But here's the catch. If too many investors keep pulling money out of the US, the dollar weakens. And if that happens, the Fed might not cut rates as quickly because they'll want to keep the dollar attractive. So yeah, it's a balancing act. Lower inflation equals good for spending and borrowing. But it also means savers earn less and foreign investors might look elsewhere. So here's the big picture. US-China. Calm for now, but still expensive. Investors moving where the value is, mostly outside the US. Inflation cooling, but that doesn't make things simple. If you're investing, saving, or just trying to figure out where the economy is headed next, keep watching this space. If you like this video, please do like and please do subscribe. We're doing this kind of videos every week. And write in the comments, would you invest in Europe or emerging markets rather than US or not? And why? Okay, thank you for watching and goodbye.